latest moves. We're going to welcome in here Eric Diton, President and Managing Director at the Wealth Alliance. Eric, it's good to see you. So I don't know if you heard Julie, we were talking there. We did get some economic data today, Eric, initial claims, another data point on the labor market as investors are trying to figure out, Eric, where this U.S. economy is and where it is headed. What do you think, Eric? What are you telling your clients?
Well, first of all, thanks for having me here today, Julie and Josh. And I made sure that today was a big update, so this would be an easy interview. So you're welcome. I actually think, look, Jay Powell wanted 2% inflation. Careful what you wish for. When you want 2% inflation and you raise rates 11 times, the economy is going to slow. And at some point, you're going to have to pivot. So we saw at the end of last week a number of really weak numbers. PMI manufacturing down 4 out of 5 months in a row, down 20 out of 21, and PMI services 76% of consumption turned negative into contraction, and that spooked the markets plus the payroll numbers. So I really believe Jay Powell should have cut last week. He didn't, and I think the markets are starting to get very comfortable with could be a 50 basis point cut in September. The Fed is behind the curve. There's not an imminent recession. We just had 2.8% GDP. Economy looks pretty strong. We're 4.3% unemployment. That's a very reasonable, solid number. But let's remember, it's almost 1 percentage point higher from where we were not long ago. So the trends are what are spooking the market, and the Fed needs to act.
Well, it seems like the Fed is going to act in September, right? I guess the question is, with the market up today, is the spooking done?
No.
So what does that process now look like?
This is the Fed has said forever that it's data dependent. And not long ago, Jay Powell said, hey, if inflation is at 2% and unemployment's at 4.2, Fed funds should be somewhere around 2.8. Hey, we're north of 5. And we're at 2.5% inflation. So we're almost there. We're almost at his target. And we just ticked above his unemployment number. And he's still sitting north of 5%. So I don't think it really matters. There's enough in the numbers for the Fed to cut, and they will.
We're also in the middle of an election year here, Eric. Politics front and center. Trump, of course, speaking today. I'm interested, when your clients are asking you how you're thinking about that, as a market pro, as a strategist, what do you tell them?
Don't get caught up. First of all, there's no clear winner right now. So a few weeks ago, you really could talk about the Trump trade. Trump had just tremendous momentum versus Joe Biden, but obviously that's done, and Harris is a contender. So you don't want to make a bet on either side. Despite the volatility and the nervousness every 4 years, the election year tends to be a good year in the market. And the last thing you want to do, and I've had some client calls saying, hey, maybe we should just move to the sidelines. There's a lot we don't know. No, don't do that. Look what happened when Trump was elected. The markets had a big sell-off in the futures overnight. And by the end of the first day, the market was up huge. So you don't want to play that game. And we don't. Stay invested.
And so what do you invest in? What are you recommending clients stay invested in right now?
Yeah, so that's the tricky part here. We need to just look at what's happening in the market here. We have gotten incredibly concentrated. You've heard people talk about it, but understand that to have Microsoft, Nvidia, Apple, 3 stocks out of 500 accounting for 20% of the S&P, that has never happened before. 5 largest stocks, 27% of the S&P. You go back to the tech bubble, and at the height, the 5 largest stocks were 18%. So we are concentrated. And what you want to see in a healthy market is diversification. So we actually go through long periods of what I call concentration cycles. and diversification cycles. And they tend to each last around a little over 10 years. This concentration cycle is the longest in history. It's coming up on 18 years. So what we're not doing, we're not loading up on big tech. Do we own it? Of course, you have to own it. AI is real. Big tech is profitable. They're growing earnings fast, but you don't want to own it the way the S&P owns it and be that concentrated. So during diversification cycles, which we're overdue for, the laggards outperform. So whereas you wanted to own the market cap weighted S&P 500 through this concentration cycle, you're going to want to own the equally weighted S&P 500 through the diversification cycle. It has outperformed through every one of those cycles. You're going to want to own small cap stocks. Understand that in the last 3 years, people don't realize this, the Russell 2000 has a negative annual return. Everyone thinks it's a rip-roaring bull market. Negative annual return. Whenever we've had subpar returns from small caps, the next 3 years, they're up 99% of the time with an average return of 16.7% per year. And they're trading at 15 times earnings. So I like those. I like dividend stocks. If you believe rates are coming down, you want to own dividends. Dividends they're like bonds. They don't mature. And they also, many of those companies raise their dividends every year. So if I'm a retiree or pre-retiree, not only do I want income, I want a rising stream of income. So if we believe rates are going to fall, I believe they will. We want to own those dividend stocks. And of course, value stocks. Value has underperformed growth through this cycle for a long, long time. You want to own value. If rates are coming down, the dollar's going to weaken. That's good for international and emerging market. And you want to own both of those as well.
All right, lots of choices and options there, Eric. Thanks a lot. Appreciate it.